Good afternoon, everyone. How are we all doing today? Good? Just so I can get a feel for the crowd, who's invested in property before? Yeah, so a few of you. Who hasn't invested in property before? Who doesn't want to know anything about property? Oh, we got one hand. Okay. And I actually was speaking to a lovely lady at the front here, and she said that she doesn't know how much money she needs to retire. Does anybody else have that same question? How much money they need to retire? Yes? So you don't know how much money you need to retire comfortably? A lot of yous? Yeah? Okay. All right, so hopefully I can answer that as well today. But the main topic that we'll be going through today is shares versus property. So the age-old question. This is a little bit of a disclaimer. Everything that I go through today is going to be general advice. There's no personal advice. So don't go, oh, Stefan from Nova Financial told me to go and do this. I didn't. You can get personal advice from us. You just come see us at our stand over there once we're done. How many people here are actually asking themselves this question? Property versus shares. Or maybe it's, do I invest in more property or do I invest in more shares? Show of hands. Okay, good. So first off, I'll go through Nova Financial, who we are and what we do. Then I'll go through the historical returns. Now, historical returns are interesting. History doesn't necessarily repeat itself, but it does tend to rhyme. So that's why we go through it. To gear or not to gear, that is a pretty big question as well. And it really depends on where you are in your financial life cycle. So I'll go into that in some more detail as well. Reinvest in liquidity, which is really exciting stuff. Diversification, another exciting one. And then questions. Actually, with no questions. Questions are at the stand, guys. Okay, so who we are and what we do. Our service. So we're financial advisors that specialise in property investment. So essentially, we found that more people, I'm Australian, so it's probably the same back in Australia as it is here, actually, we found. More people are comfortable investing in bricks and mortar than they are investing in shares. And probably that's because they feel as though they get an understanding or they understand property a little bit more so than shares. However, what we found is that you can't get really good advice surrounding property the same way you could get advice surrounding shares. It gets quite technical. There wasn't the same advice surrounding property, or you had to go to a real estate agent to get advice, or you had to go to IFA and they'd recommend property trusts or property syndicates and stuff like that, which is listed in their behaviour is quite similar to shares anyway. So we entered in and we brought in the same acumen as IFAs, but we applied it to property investment. So essentially what we do is we get a thorough understanding of our clients' goals and objectives. If they don't have goals, we help them find out what their goals should be. If they don't have any objectives, then we help them with that too. And then we work ourselves back to where we are today and figure out what is the best plan to actually achieve those goals. In terms of our qualifications, all of our advisors are at least degree qualified. We're qualified financial advisors and we're qualified mortgage advisors as well. In terms of the relationships that we have, so I'll take you through a little bit of our management team, but we do have a lot of experience and a lot of strong relationships within the property sector, but also the financial advice industry as well. So what that means is we're able to leverage off those relationships to get the most out of most for our clients. Most out of our clients. We don't charge any upfront fees, which brings us to my next point. We get the most from the market for our clients. And what that means is getting the best deals, finding out the best and most important information that's out there. Because when you're doing your research, and we understand that when you're doing your research and you're doing your Googling, it's really hard to figure out actually what is the best thing for you. There's so many different options available to you. There's so many different types of investments, whether it's under shares, property, and fixed income. It's very hard to figure out what's best for you. And so that's what we try and assist our clients with the most. And I'll take you through our experience in terms of the back end as well. What makes us different? We believe that we apply the right weighting to the psychological outcomes of investing relative to our clients. What that actually means is we believe that it doesn't make sense for a client to do anything unless they're really comfortable with that investment and they're comfortable to hold that investment over the very long term. because that's where you really do get the benefit from investing. It's not 1 to 2 years or 3 years, it's 5, 10, 15 plus years. Okay, is the answer simple? Well, no, it's not. Historical returns. Okay, so this is a graph that was done by Wrigglesworth. It was commissioned by Paragon Mortgages. It's called Buy-to-Let Comes of Age. So essentially what it was is buy-to-let mortgages have been available from 1996, and so it was once they turned 18 years of age. And it shows the returns across the different asset classes. So if we were to all go up in a spaceship and look down on the financial landscape, we would see 3 peaks. And the peaks would be shares, property, and fixed income. Those are basically the 3 things that you can invest in. So across those 3, you can see that the returns here are quite stark in terms of their differences. Non-leveraged buy-to-let is about just under 10%, commercial property about 8%, and then you go to your shares, FTSE All, which is about 6.8%. And then you have your gilts, which is basically bonds, 6.5%, and cash of 4%. So going back to, and then of course in terms of leverage, 75% leveraged buy-to-lets, which means that you take 25%, put down as a deposit. Now that could be of cash, that could be redrawn from another investment or your home, and then borrowing 75% to invest in one creature, being a property. And obviously the returns there are 16%. Now that's, what's really at play there is the ability to leverage. It's really to get a greater return on your cash applied by investing in a much bigger creature. So, but going back to what we were talking about earlier in terms of people not really knowing what they should be, where they should be going or how they should be investing. I would say that if you can achieve your financial goals by investing in cash, then do it. If you don't need any more than that, then invest in cash. But a lot of people can't actually do that. They have to go out and send their money into the big bad world of risk and return. And by doing so, you have all of these other options here. And then you need to ask yourself, well, how much money do I need in retirement? Now, the average couple in the UK probably needs about £20,000 to £30,000 in retirement to achieve their financial goals. And if that's yourself, if that's 30,000, the easy way to calculate that is times it by 20. So whatever passive income goal that you want to achieve or believe that you'll need to achieve at retirement, today you times it by 20 and that gives you an asset base. So if it's 30,000, times it by 20, that gives you 600,000 as an investable asset base. And the reason why we times it by 20 is because we make the assumption that you'll be able to generate a 5% return on that investable asset base. Does that make sense, everyone? Yeah? Okay. So essentially you invest that at 5% and that's the return that you can get. Now, if you need to get greater returns than 4% to get to £600,000 in the time frame that you have between now and when you would like to retire, what do you have to do? You'd have to invest in something that's going to give you greater return. That's exactly right. So you have to look along this spectrum here. Now, for a lot of people, unfortunately, the case is that a lot of people can't achieve their goals by investing in these ways. Unless they've already built up the assets over their life and they're ready to retire and they're ready now just to squeeze the lemon, then fantastic, well done. You can invest in this way. But for a lot of people, that's not available to them, and therefore it does make sense to take on leverage. So which is right for you? So I've talked a little bit about that already, but it really does depend. It depends on where you are in life, how much time you have to grow your assets. Because when we're talking about leverage, and that's really the big difference between whether you're going to get greater returns in property or if you're going to get more average returns in shares, it's the ability to take on leverage and maximize your overall return. Property makes sense if you're still in your wealth creation phase, if you still have time to, if you're still working, if you still have time to apply to growing your wealth, and therefore taking on leverage and the risk associated with having a mortgage. And if you don't have a tenant, you can still, for a period of time, you can still pay it from your income for a period of time if you do have any vacancy periods. It also allows you to reinvest capital. So if you do get growth in your property, you're able to, and use your positive cash flows to pay down debt, you're able to draw out that equity to then reinvest. When it comes to shares, that's quite difficult. You're not able to do that as much. And the reason that is because you're getting growth in the share portfolio. You don't really have any other capital other than the amount that you're saving to then buy more shares. In terms of borrowing to invest in shares, some of you might be asking. It's quite difficult to borrow to invest in shares, not necessarily because it's technical, but essentially the amounts that you can borrow are significantly smaller than you can borrow for property. You actually have to buy. You purchase. The interest rate is a lot higher. So you're looking at interest rates at about 6.7% plus versus the actual yields that you're getting from your share portfolio on average. You're more looking at about 4.6%. So you're actually going to be paying out of pocket to pay your interest repayments. And if the portfolio size for your shares actually goes down as well below your leverage, you have these things called margin calls, which essentially means that you're going to have to actually front up more capital or have to sell part of your portfolio to fund the bank, which is not great. What you do get, some of the positive though associated with shares is the ability to diversify. So you have a much stronger ability to diversify in the sense that you can invest in a unit trust and invest in many different types of shares. With property, you don't have that as much. You're quite restricted in the ability to diversify, although diversification is a risk-reducing tool. And the way that we reduce risk, essentially, is by knowing your basket very, very well. So it's not about going out into the market for property and just choosing anywhere. It's about having a methodical approach to where you're going to be investing and how you're going to be investing. And in terms of liquidity, shares are obviously more liquid than property. However, I like the fact that properties are quite illiquid. There's higher associated costs to get into property. So you have to pay stamp duty, you have to pay legal fees and stuff like that. The frictional costs associated with buying a property means that you're not going to quickly sell it if you hear on the news that, say, trade talks with China have gone negatively, and that's going to have an impact on the market. So it really protects ourselves from ourselves. We can actually buy a property. No one's going to wake up and want to sell their property the next day, which really means we can get the full benefit of the cycle. We can buy a property, wait it out, and get because it's time in the market versus time in the market. So I think it's actually quite a positive thing when it comes to illiquidity, when it comes to property and shares. But the most important thing is get the right advice for you. I think that's probably the key. Okay, so here's some importance of having a plan or a written strategy. This is something that we do assist our clients with a lot, and I suggest anyone that doesn't know or put their hand up early about not knowing where they would like to go, not knowing what they need from their retirement, to go speak to an advisor and find out and get a gauge on what they should be, where they should be sitting in terms of their finances, how much they need to be saving, or what sort of goal they should be achieving. But once you do have the goal, and once you do have the goal and where you would like to go, it's really important that you do have a plan. Because if you just have a plan, it's just a dream. So if you just have the goal, it's just a dream. And so this is a study that Harvard did quite some time ago. It was with the MBA students, and it was asked, they were all asked, have you set clear written goals for your future and made plans to accomplishment? So 3% had goals which were written down, 13% had goals but they were not written down, and 84% had no specific goals. And as you can imagine, 10 years later when they spoke to these people again, the 3 people that had goals written down were earning 10 times as much as the 97 combined. Now, what's clear with that is rather than doing your Googling and finding out where to invest and how to invest, figure out what it is that you need from your investments first, and then work yourself back from that. Because it will be much easier for you to figure out exactly what you need if you know where you're going. And that's probably, I would say, the biggest problem that we see with people not knowing and having confidence in their finances is not actually knowing where they're heading, and actually what to expect from their finances that they've built up over time. But once you do have that figured out, that's a big step in the right direction. And then you work yourself back from there and figure out what types of returns that you should be generating, and then also what types of investments you should be investing in. We're actually running a promotion at the moment. for people to come in and meet with us on a complimentary basis. So what that means is you essentially sit with one of our advisors. They'll get a thorough understanding of what it is that you're hoping to achieve, your goals and objectives. And as I said, we have certain models and ways to approach people that don't know where they're heading or don't have an idea of what they need out of their finances or what it means to have a comfortable retirement. We can talk to you about that in a very exhaustive way, so you walk away knowing exactly where you need to be. Once we have that, where we know that, we'll be able to help you then determine what is the best strategy to actually get to that goal. Now, it's not our responsibility for you to achieve your goals. Of course, you need to have the right resources and have the right attitude. But if you do, we're able to provide you with the right strategy and then also specific recommendations on how to best get there. And usually there's a cost associated with that, but we're happy to waive that fee for people that fill out their feedback forms and come to our stand a little bit later on. And that's our offices are in central London, just in between Bank and Moorgate. Now, in terms of the management team, so the reason why we have some of us are a little bit more fresh-faced than others, but overall there's a lot of experience here. A person with money meets a person with experience. The person with experience leaves with the money. The person with money leaves with experience. An old adage for you. So essentially what it means is we need to have experience. Experience goes a long way. Doesn't necessarily mean everything, but it's good to have people that have been in the market. All of these individuals, including myself, I've invested and provided advice across shares, property and interest-based securities. The same thing with Paul. Ian, who heads our advisory board, is essentially, he was 30 years of experience as CEO of Vale Williams, which is a property consultancy business. Every single time we provide advice to one of our clients, it goes through all of us, and we all have to tick it off to make sure that it is in line with what the clients want and their objectives, and they're going to get full benefit out of it. If we don't feel as though we can help someone, we don't take them on board as a client. It's simple as that.